A new trade war has started in the world. Majority of the stocks are near 52-week lows. The money sort of starts rushing towards high quality stocks. Such type of investing typically leads to some overvaluation. We have to start looking at this factor and maybe adding some allocation to this in our strategies. Hello everyone and welcome to the bear market. So we all know that the market has shifted its directions since January. There's a huge trend that is happening. We've seen 6 consecutive months of decline in the market, which is something that hasn't happened since 1996. Majority of the stocks are near 52-week lows. You've seen 30-40% decline in many small caps. So it's a new type of market that we're seeing. And in this video, what we will try to understand is how do we invest in such circumstances? Is momentum the way to go, or do we have to shift to quality to tackle these markets? Let's first start by understanding what is the reason of this volatility and why the markets are correcting so much. I think recently the trade war being announced by Donald Trump is putting a pressure on geographies across the world. India is seeing a significant decline, and similarly I think in the US also you have seen some corrections. And see, what is there to understand is that this pain could actually continue for some time till a trade deal is cracked, or the war situation in Ukraine and Gaza are solved. So we might see a continued volatility. We don't expect big crashes in this market, but we do expect a change in market behavior. And in this changing market, we want to understand what type of stocks will give us some alpha over the market. So let's start by trying to understand the two factors that we are talking about. First of all, for people who don't know, factor investing is the type of investing where we try to understand certain characteristics of stocks that will give them an edge over the others. Momentum investing is a behavioral factor. What it means is that you are looking at stocks that have picked up a trend, stocks that are doing well in the recent times, you invest into that, and that is based on investor behavior, right? That more and more people, when they pile up on a stock, the stock price rises, and that is where you make your returns. Such type of investing typically leads to some overvaluation, right? The PE levels, the valuations are not a concern when you're doing momentum investing, and in times of risk you can see some correction there. On the other hand, you have quality stocks that are utilizing the cash really well, that have very strong and solid books, that have some sort of a business mode that will keep them afloat in any sort of volatility. So typically when you see heightened volatility, when you see people leaving the high valued stocks, people leaving small cap stocks where there's a lot of speculation, the money sort of starts rushing towards high quality stocks that have cash in the balance sheet, stocks that utilize that cash really well, stocks that give a very good return on capital and return on earnings. And we actually ran the numbers on the last trade war, the 2018 to 2020 trade war, when there was persistent volatility in the small and mid caps. And during that time, you could see Nifty do really well, and actually quality stocks do better than the Nifty. Now obviously that is not to say that momentum investing is over, or you should not invest in momentum stocks anymore. First thing we have to try to understand is why has momentum worked, and it has worked really well in the last 5 years. Like I said, momentum is a behavioral factor. It is based on investor behaviors. The market actually does not follow the exact rules of valuations, right? What happens is that even though there is a valuation change in a particular stock, until unless you see a herding of capital towards that particular stock, more and more buyers, you will not see a trend happen. So a momentum investing strategy captures a trend that might have been formed due to some economic rationale, and it tries to capitalize on that trend. Momentum investing, like I said, is justified by the herding behavior of investors, and actually momentum investors make more return on their capital because they're taking that higher risk of investing into high volatility stocks, and they're taking the high risk of potentially correcting in during market downturns. Momentum investing is a very dynamic strategy. So while in a bull market it will go to maybe small caps and highly cyclical stocks, in a bear market you will see the same strategy pivot towards slightly safer companies as well. So momentum dynamically adjusts with the market, but there are phases when you will see some significant correction happen in momentum strategy where other strategies will outperform. Momentum can also experience short-term crashes. So we've seen a crash in momentum 2021, 2008, 2018, 2023, and most recently 2025. 2025 January crash in momentum was in fact one of the worst months for momentum in the last 2 decades. It's among the top 20 worst months for momentum that we have ever seen. So it is a very significant event that has happened, and that sort of signifies that there is a shift that has happened, and we have to evaluate the cyclical nature of factors. Now let's try to understand if we have to get out of momentum or should we still be allocated. I think right now having a diversified approach definitely makes sense. You will see momentum adjust to the market behavior and maybe go towards the larger caps and high quality stocks. But due to the nature of momentum, it has seen some correction in the near term. And what we have to also understand is that once the market recovers, you will see a bigger sort of recovery happen in the momentum factor. But like everybody in the world, we are not sure when that happens. Now, the second big point that we want to note here in this video is that the factors that we look at are cyclical. Momentum works very good in certain scenarios, but there are other phases when momentum might not work that well. And during that phase, something or the other might do better. So, for example, a quality company or a low volatility company, and we see that quality and low volatility typically have a high correlation, right? They work together. So those companies might do well, and in some scenarios you will see value stocks that are undervalued might actually do better than momentum in certain phases of the market. So if you are following factor investing, then what you have to do is you have to understand the cyclical nature of factors and be able to pivot from one factor to another based on significant changes in the market direction. Now, when we see such phases when momentum is crashing, what we have seen is that quality can shine during those times. So if you look at the worst 25 months for momentum, out of those 25 months, 22 times quality has actually done extremely better than momentum. So it is a complementary strategy to momentum which can give you alpha when you are seeing a momentum crash. So first of all, what are quality stocks? Quality stocks are stocks that have lower volatility and which can give you better risk adjusted returns. Unlike momentum, quality does not look at price trends. Quality looks at the quality of earnings or the quality of management for the company. It is based on fundamentals. So it will look at things like return on earning, return on capital invested, ratios like asset turnover, ratios like how well the company is utilizing the cash, and that is how it will select companies. So the focus of a quality investing strategy is to invest into healthy companies that have very strong earnings and stable financials. And such type of companies can only provide you cushion during any sort of market downturns. So what is quality investing? Quality investing is investing into high quality stocks, which we discussed can be differentiated based on the fundamentals. A simple analogy will be that let's say you go to the grocery store and you have an organic and a non-organic apple to buy. An organic apple would be high quality and that would be a quality thing to buy. Similarly, a quality investor tries to get a higher return on investment by investing into quality products. And the fundamental theory behind this strategy is that quality companies demand a premium in terms of valuation. They have greater demand, especially during volatile times, and that sort of works for these companies in certain phases of the market. So what are the characteristics of quality companies? Characteristics are strong earnings and stable finances. Second thing is that they have proven historical success. They have consistently historically done well for their investors. And finally, quantifiable metrics like return on equity, asset turnover, return on cash, things like that are very consistently high for these companies. So now let's talk about the current scenario and why we are actually looking at quality as a focus area. As we all know, a new trade war has started in the world. Donald Trump, after his inauguration in January, first threatened tariffs against China and Canada. The Canada tariffs were revoked, but China tariffs are still there. Now he has threatened tariffs against European Union. He's also spoken against Indian tariffs. So there is heightened volatility across the board. People think that the global order is going to change. Money is going to go out of these countries, maybe rush towards the US or maybe towards China if it looks attractive. And this is not the first time that we are seeing such a trade war scenario. If you actually look at 2018 to 2020, when there was a time of high volatility in the world, during that time we saw a correction into high beta factors, correction into highly valued companies, right? We saw a very big differential between large caps and small and mid caps. There was a big divide of almost 30-40% in their performance during that time. Larger stocks were relatively stable, but small and mid caps saw some correction. Now this scenario can be very, very different. We don't know what happens yet, but getting our lessons from that scenario, we think that investing into quality or having a bias towards very high quality large and mid caps during this time could in fact be a profitable strategy. If you look at the chart of the performance of the factors during the trade war, you would see that the quality had been the best performing factor among all the factors during that time. And even recently, if you look at the charts of the factors in the recent past, what you would see is that while momentum has had a very, very bad month, your quality investing has in fact done the best during this point in time, which gives us a sense that we have to start looking at this factor and maybe adding some allocation to this in our strategies. So in our strategies, the multi-factor strategy that we run on our PMS, the multi-factor portfolios that we have on our small cases, and even some of the momentum strategies that we have in both these platforms, what we have seen is that quality larger cap companies are getting more allocation. What we have seen in our strategy is that over the last couple of years, we've seen a big rally happen in small and mid caps, and our strategies have also built that bias. We've started looking at a very broad set of stocks. We have gone to 700, 800, 900 and then 2000 stocks, and we have tried to include as many small and micro caps. But we can see that shift happen, and our focus is now shifting towards more large and mid caps. We're focusing on only the top 500 or so companies right now. And the focus is shifting or pivoting a little bit towards high quality, along with our continued focus on strong fundamentals, strong momentum and strong estimates for these companies. So the main crux of this video is that the market is shifting and we have to adapt our strategies. One thing that investors have to do during this time is not to panic. The market will allow opportunities even in a bearish phase, and that is what we see towards quality investing. Momentum investing might have had a bad few months, but we will see stability in those strategies also. And if we are looking for higher alpha, if we are looking to beat the market even in these scenarios, then we are very confident that there are other strategies in place, maybe quality, maybe looking at valuations, maybe looking at combination of momentum, quality and valuation will deliver higher alpha in comparison to the market, and that is where we will see our strategies pivot. So while investors have seen bias like us over the last couple of years, and they've started looking at smaller and smaller stocks, not caring about valuations that much, focusing on high growth, not counting for the quality of the company, I think the pivot for investor focus might shift in the recent months, and we might have to start looking at the quality of earnings as well. So as momentum faces some scrutiny, quality could in fact be your next winning trade. So that was our coverage on the shifting market scenario, and we would love for you to comment on how do you see this perspective change. Are you betting on quality companies or are you still invested in momentum? Do let us know in the comments. If you like this video, hit the like button, subscribe to our channel and share it across to your friends. We'll see you in the next video. Until then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.